Okay, let's go ahead and get started. Welcome everyone to the third and final installment of our Revenue Cycle Benchmarking Series. I'm Ed Tishan, Director of Business Development with Regent Revenue Cycle Management based in Chicago. So we've designed today's session with a bit more spice, centered around one simple but impactful element, that being interpretation, or really the ability to take a critical look at what performance metrics are really communicating. Like all metrics, context becomes critical to a clear understanding of both input and output. For those of you new to the series, your host organization, Regent Revenue Cycle Management, operates as an independent division of Regent Surgical Health, a 15-year veteran in the ASC industry. Back in 2005, Regent Revenue Cycle was launched as a central billing office supporting Regent centers, and in 2014 expanded its services out to the entire ASC community. Quite simply, performance benchmarking continues to be an integral part of the team's operations and, of course, focus on continuous improvement. Similar to previous sessions, we'll keep the event in mute mode to avoid background noise. Please do route your questions throughout the course of the presentation through the WebEx Q&A function. So I want to start with three questions to frame today's discussion in the spirit of taking a deeper look at performance metrics. Question number one, looking at the 5 recommended RCM performance metrics from our previous discussion, which have the fortitude to stand alone and which can be manipulated? Question number 2, is there a 6th revenue cycle performance metric that is pure above all others, and if so, what drives its importance? And the third and final question, so with 6 recommended revenue cycle performance metrics, how can I confidently capture my center's performance across each metric and know where I really stand? So with that as the backdrop, I'd like to turn the mic over to Mike Orsino, Vice President of Regent RCM. Mike sits at the heart of monitoring and managing all performance metrics for the organization. Mike?
Thank you, Ed. And again, we appreciate all of you joining, taking time out of your busy days to sit with us through this session. I'm happy to say that we are presenting from sunny Chicago with winter releasing its death grip on our city. We're finally above the 60 mark, I think, for the first time in the past couple of weeks. So with that, I'm going to start off by just refreshing what we've covered already with the benchmarking. The 5 different KPIs or key performance indicators that we spoke about was days outstanding, days in AR, and our Regent standard is less than 30 days. But as we discussed before, this can be manipulated and can be really impacted by your case mix or payer mix. Percent of AR greater than 90 days, where our standard is less than 15%. Claim lag or charge lag, where the Regent standard is less than 3 days. Statement lag, less than 5 days, and finally the denial percentage and clean claim percentage, less than 10% for the denials, and trying to maintain a 98% clean claim rate. I'm going to look at each one of these individually again, but we're going to add a little bit of a twist. We're going to talk about how each one of these KPIs can be manipulated. So let's take the first one, the days outstanding or days in AR. And if you recall, it's in the definition in its most basic form, it's really essentially the time it takes to get a claim paid. The calculation is the total AR divided by the total charges from the last 3 months divided by 90. Our Regent standard, again, is less than 30 days, and we use this to determine the health of your AR. If you start seeing wild swings from month to month, it may highlight a billing or collection problem. Now, we added this piece to each one of these, and that's the manipulations. So how can this figure be manipulated? What we've seen is if a biller or collector starts writing off balances prematurely or using this catchphrase, capturing only the low-hanging fruit, they can make a days outstanding or days in the AR look very, very good. So we've seen centers where the days in AR may be less than 30, maybe in the 25, 20. But that doesn't necessarily mean they're financially sound, and we'll explore more later about this. But we're going to look at each one of these and just look at how each one of these can be manipulated. So those of you in management or administrators really need to not just take the number on its own. Percent of AR greater than 90 days. The definition, the amount of dollars as it relates to total AR greater than 90 days outstanding. Calculation, total AR greater than 90 days divided by your total AR. Our standard is less than 15%, and we use, the uses is a high percentage of the AR greater than 90 days may emphasize an issue with patient collections or insurance denials. How can this number be manipulated? Again, it's very similar to days outstanding. It's writing off balances prematurely if your bill or collector is lack of payer or patient follow-up. So essentially, you can manipulate these two figures pretty easily. So whatever the insurance company is paying at first blush, let's say your contract amount is $1,500 and they pay you $1,350. Your bill or collector can just take that $1,350 as full payment, write off the remainder, and if you're not looking closely, no one will know the wiser, and your metrics all look great. Same thing with percent over 90. You know, they can do the same thing and just make sure that balances aren't aging. They can also, if you know, they don't want to wait too long for an insurance payment, they can just write off a balance completely to make this metric look good. Charge lag, claim lag. Again, this is, the definition is the time it takes to get a claim entered is the charge lag, and the claim lag is the time it takes to get a claim sent. Calculation is the number of days from date of service to charge entry or claim submission. Our standard is less than 3 days. And charge lag and claim lag determines how quickly charges are being sent. A high claim or charge lag has a negative impact on days outstanding. And put manipulation in here, but not so much manipulation, but this is more of a piece that is out of your revenue cycle or business office's control. So physicians, if physicians are not dictating in a timely manner, this will skew this charge lag or claim lag negatively. So you'll see a higher claim or charge lag, and that may not be a result of your business office efficiency, but more of just physicians not dictating timely. And I think everyone on this call can relate to at least one or two physicians in the organization who are chronically behind in their dictations. So, you know, not so much manipulation on the business office staff, but more as a something out of their control. Statement lag, the time it takes to send out patient statements. The calculation is the number of days from the date of patient responsibility to date the patient is sent, statement was sent. Our standard is less than 5 days, so we drop statements on a weekly cycle. Every week we drop them, and each patient is on their own respective 30-day cycle. And this determines the efficiency of your RCM staff. If you start seeing a high statement lag, this decreases the probability of a balance being paid. The way to manipulate this is not so much the drop in the actual number, but if your staff are sending out statements with no patient follow-up or no skip tracing, that can highlight an issue. So if they're just sending out statements and they do not call the patients, obviously the chances of getting paid decrease. If they're not performing skip tracing if they're not performing skip tracing on the statements that get rejected or fail to go to an address, again, that decreases your chances of getting paid. Denial percentage and clean claim percentage. Percentage of claims that are rejected by a payer and the percent of claims sent without edits. Calculation is the either denied or clean claims divided by your total claims. Our standard is we want to send out 98% of our claims clean, and we want to get 5% denied, less. High denial rate could highlight issues with certain payers. A low clean claim percentage may pinpoint some issues with either your biller or front office. So the way to manipulate this piece is, if you think about it, to maintain a low denial rate or a high clean claim percentage, centers may be undercoding claims. So if you think about certain procedures, there may be expanded codes or maybe implant codes or different codes that can maximize reimbursement. By playing it safe, if the mandate of the center is to keep a denial percentage or a clean claim percentage above or below a certain number, sometimes the biller may want to play it safe and not use codes that may try to maximize reimbursement or that may have a chance of being rejected. So there is a chance that you're not maximizing reimbursement by undercoding certain claims in order to maintain a high claim percentage or a low denial percentage. Ultimately, at the end of the day, you want to maximize that reimbursement, and if that comes at the cost of maybe a higher denial percentage or a lower clean claim percentage, so be it. And finally, I want to talk about a metric that we haven't spoke about before, and that's the net collection rate. And the net collection rate is really at the heart of this particular segment of the webinar series. And the definition of the net collection rate is the percentage of eligible dollars the facility actually collected. So think about, this is only true for contracted payers. So going back to my previous example, if your contractual rate with a payer is $1,500, you want to make sure that you're collecting $1,500. So whatever is actually owed to you, that you're collecting what is owed. The calculation is how much the total payment for that particular claim divided by the total charge minus your contractual minus bad debt plus refunds. And our standard is greater than 97%. And 97% really is the threshold. And we're looking really at 99. We strive for 99. If you perform this calculation on your claims and you see that you're getting 94%, 93%, typically, 93% is usually a pretty good score. With a net collection rate, it's a poor score. That means you're losing out on 6 to 7% of what you should be collecting. So, and when you're talking hundreds of thousands or millions of dollars, that number can add up to quite a bit of money. So the use it determines how well the business office staff are collecting on your contractual amounts. And really, the manipulations there really aren't any. It's very difficult, near impossible for your business office staff to manipulate this number. That's why we call the net collection rate. We sometimes refer to it as the great lie detector, because all the other metrics that we discussed previously, they could be manipulated in one way or another, or maybe like, for instance, the lags, the charge lags can be manipulated by a physician. This particular metric cannot be manipulated by your staff. The only way this can be manipulated is by the person doing the calculation, which would be you, and I doubt you'd want to manipulate your own figures. So the only difference where I've seen net collection rate is, if you look at the calculation, you see the total charge minus contractual, it's that bad debt piece. That's the only particular way where someone who's doing the calculation can manipulate it, because different facilities define bad debt differently. So, some people have a very broad definition of bad debt, some people have a very narrow definition. So that's really the only manipulation of this figure. Otherwise, it's a pretty straightforward number. Obviously, you want to strive for greater than 97%, 99% is ideal. I'm now going to turn the microphone back over to Ed, and he's going to go through a revenue cycle audit.
Thank you, Mike. So with a total of 6 recommended revenue cycle performance metrics at this stage, how can a center confidently capture performance metrics and get a solid sense of where they stand? One of the recommendations that we wanted to put on the table sits squarely with an audit, and in fact a revenue cycle audit. What we found historically is that most centers don't have the luxury of having a strong financial contact that's performed audits before, or an equity partner defined as a hospital partner or others that has that expertise and is willing to share. So as we look at the marketplace, ultimately we would recommend that a center looks for an auditor specifically in the ASC community to provide relevant qualitative and quantitative insights. And that second piece really speaks volumes. So as you look at an auditor, ultimately they should have a tool set that ultimately gives key values for the performance metrics. So in terms of cost, most commercial auditors obviously do have a charge associated with their services. Again, we would challenge centers to look across the ASC community to specific providers, as many of those auditors do not charge. And in fact, the audit is a fundamental mechanism for them to show where they can add value in the overall process. And if you look at the audit itself, we would highly recommend 4 key areas to give a full 360-degree view: reimbursement, coding, staffing, and workflow and process. And that fourth might seem a bit nebulous. However, if you look at flow and process in a business office, it all boils down to efficiencies. And those efficiencies, again, are human-related, they're technology-related, they are, again, pure process-related. So, again, most think of reimbursement, coding, and staffing as the key metrics in the audit. We'll put workflow and process as yet another that we think is critical to understanding what is happening. So one final thought as well on the audit, again, recommendation from our vantage point. I mentioned tool sets before. Look for a tool set that's been refined for at least 8 to 10 years. As you partner for an audit, that audit most likely will last anywhere from 2 to 4 weeks, maybe as many as 5. You'll look for a formal presentation coming out of that audit, and again, organic to the audit process itself, look for quantitative findings and recommendations that ultimately support changes and support how you might do things in a different manner, ultimately in the ASC. Mike, let me turn it back to you.
Okay. Finally, we'd like to wrap up the webinar series and go through a few different takeaways that we hope that we achieved for you. First, that you're able to identify and define 6 recommended revenue cycle performance metrics that will form the foundation of your center's revenue cycle center of excellence. Provide the ability to calculate, interpret, and prove the integrity of performance metrics being reported within a center. Provide insight into readily available reporting and analytical tools, plus real-time monitoring, management, and dashboard capabilities. And provide awareness to ASC-specific audit expertise and essential audit criteria to ensure an effective approach and value-added outcome. So all this being said, and the 3 different webinars that we've covered with all the different metrics, I hope the message that was received by all of you is that we want to make sure that you have the tools in order to measure these metrics and be able to identify where the metrics can be manipulated. But I think the most important message that we want to put out to all of you is that don't be blinded by these metrics. You know, don't take them one by one or even all together. Ultimately, at the end of the day, we want to make sure that everyone understands that ultimately cash is king, and that's the bottom line. So you can have metrics that are gold standard in every category, but if you're not bringing in the cash, the metrics aren't doing you much good. So, you know, metrics are great. We use them as an everyday tool, but make sure they're only a tool, and make sure you keep your eyes on the prize. And like I said, ultimately, cash is king. And I think from a famous movie, we can, if you want to remember it, you know, show me the money, always about the money. So with that, I'd like to open it up to any questions that anyone might want to ask.
So Mike, at this time there are no questions coming in from the audience. Mike, I want to thank you for emceeing each of the 3 presentations for the webinar series. We appreciate your insight and expertise. Again, I don't see any additional questions coming in. With that, we will cut everybody loose early, about 23 minutes after. Thank you to everyone for your participation today, for your participation on the 2 previous webinars, and we look forward to seeing you either at ASCA upcoming or potentially one of the Becker's events. Again, thank you, everyone.
Thank you all.
Bye-bye.
Bye-bye.